Good evening. It's September 1st, Thursday, 8:21 p.m. Good evening to you, Awi.
Good evening, Mark
And good evening to our listeners. This is Mark Yu.
and Wawi Santos.
And welcome to the Mark Yu and Awi show. Welcome to episode 53, everybody. Um,
53.
yeah, finally we made the 53. Me and Wawi are both physical therapists here in the USA with a passion and interest in investing our hard-earned money in the stock market. So don't consider what you hear from here as investment advice. The title of this episode is Love the Volatility. I guess because we chose this title because I think while for the past couple of weeks, it's been a wild ride in the stock market. Would you say?
Yes, it's mostly going downwards, and it's been especially hard going downward on the Nasdaq.
Yeah, more on the tech being hit, but a little bit more on that in a second as we take a review of the sentiments in Wall Street as well as the performance of corresponding industries. So as we always take a look at least once a week is the American Association of Individual Investors sentiment. So, according to this group, there are a lot less people that are bullish or thinking that the stock market will go up in the next coming weeks. We are down from 27.7 down to 21.9 as of yesterday. And there are a lot more people being bearish from 42.4 or up to 50.4%. That's this. Do you think? I think this adequately reflects what's happening with the market right now, right, Wawi?
Yeah, so yeah, the sentiment reflects what's going on right now. It's risk off.
Mhm.
Medyo natatakot ang mga investor ngayon.
Right.
Mhm.
People trying to hold their cash or at least not buying any stocks at the moment. And if we're gonna take a look, the fear and greed index, we are actually at somewhere at neutral, almost just a tad bit. We're back to fear again. Whereas just a week ago, we were at greed at 58. Currently, we're at 45. How things quickly change, right, Wawi?
Mhm. I think it started when Jay Powell talked. I think was it earlier this week when
Yeah, last Thursday.
yeah last
Um,
week.
he
Mhm.
said that the Federal Reserve will gonna keep on hiking rates, and
Mhm.
most of the federal governors are backing him up. So look at that sharp reversal. Well, not sharp, but I would say some kind of like reflection point.
Mhm.
From August 25th, we were the S&P 500 or the biggest 500 companies in the stock market here in the US take a nosedive from
Yeah,
above its 125 moving average. We're down to at least 4,000. Yes, Wawi.
yeah, I think for our listeners, I think they need to understand that the market is quick to price things in. So when they hear something like Jay Powell being more hawkish, raising interest rates, you will see the market respond appropriately by a downward trend.
Mm-hmm.
Um, so I would just say, for our listeners out there that are just new to this thing, don't panic. It's just a rational reaction of the market, um, in my opinion, for
Right.
the most part.
And what's popping up on my screen, on our screen right now, is the stock price breadth. This is interesting, Wawi. For the past few
Oh.
months, we've been seeing low active activity among the investors buying and selling the stocks. But you could very well tell, like as of the when the rally or when the market had bottomed back in July, or hopefully had bottomed, stock trading has been ramping up
Mm-hmm.
at least until mid-August, and then it slowly died down a little bit. So people are now back from the summer vacation, taking a look at their portfolios and deciding to make moves, probably buying and selling a lot. So there is
Mm-hmm.
a little bit more conviction in what's happening now in the stock market. Should it go up or further down? So if it just goes further down from here with high volume, it just means that people are liquidating their portfolio or started selling off their poorly performing stocks.
Mhm. Or being choosy with their trades.
Mm-hmm. And here we are at looking at the put and call options, the tail that wags the dog. This adds to the volatility of the market. So right now there's extreme fear in the options market. People are buying more put options or what do you call this? Not insurance, but contracts that would prevent uh, not prevent, but what's a better term? They're buying contracts that would at least help them avoid total losses in their stock portfolios should the market go down from here. So the higher the put and call options are, the bearish or the more negative the people are or the investors overall. So we're seeing a very much an uptrend since mid-August to present. So as we were discussing earlier, the volatility also as well has been climbing. Volatility for the past week has climbed from would you say Huawei 19 points to now at 25.56.
Just looking at individual stock volatility in the past 5 days, you could see like an increase as well.
Mhm. So yeah, so the higher the volatility means the more sell-off that the index is happening. For the S&P 500, it's the volatility or VIX ticker. For the Nasdaq, which is more of the tech names, it's VXN. It also has shown a ramp up since last week. Last week it was at 30. Right now it's at 32. So it has climbed a little bit. And now we're going to take a look at the sectors as what we have talked about in our opener. So for the past week, each and every sector again is down. This is not new, Huawei, right? We've seen
Yes.
this all year long, except between mid-July to at least as of last week.
Hmm. I
So,
think with the hawkish stance that we're predicting, it's
mhm.
gonna be a uh, long year,
Yep.
towards reaching the 2% um, that the Federal Reserve is trying to reach.
Yeah, I don't know why they keep sticking with that 2% goal. We're currently at 9%, and the real data shows it's more than that even. They're
Hmm.
wanting like, you know, from 9 down to 2. That's a big drop. That's more than 50-80% drop of inflation in terms of growth or decline. So I don't know why these Federal Reserves still keep like hanging on to that number. It's not like they want to see more job losses or more pain, as Jerome Powell would like to term it. We'll use that
Hmm.
term, that the United States or Americans need to suffer along the way so that they could meet their goal of 2%. I don't think that makes any sense at this point. But yeah, it's definitely making a
Hmm.
big change. People are hurting, portfolios are suffering, jobs are being taken off the market. It started with newly minted tech companies that can't make any profits, and now we're at how much the big companies that are now laying off. Google have stopped hiring, Facebook have stopped hiring, Snapchat is laying off 20%. And this is what the Federal Reserve wants. So let's see how long will it take until they realize that it's really hard to bring it down to 2%. What do you think, Wowie?
Well, I agree with you because that's one driving factor to the inflation: high wages.
Right.
And right now we have two jobs for every American that's looking for a job. It's very tight still.
Mhm.
But we're already seeing signs that, like you said, layoffs are coming.
Right.
So they, they said they're going to look at this lagging data. So data
Mhm.
that's behind the trend to um, to determine how much they're gonna increase or decrease their rate hikes. But
Right.
I agree with you, Mark. It's gonna be a lot of pain
Mhm.
because if you start seeing people losing jobs, then um, with the inflation, I think is already embedded. and priced in the system, I
Right.
think some of the pain we're gonna have may be unnecessary if they
Mhm.
continue raising these rates
Totally.
at high levels, and that's what we call a recession when when people are unable to buy, to
Right.
be consumers in the
True.
market.
I mean, the Federal Reserve, if they want people just rely on their credit cards, they might as well just jack up their interest rates, not by
Oh,
75
that's
basis points, but raise it up to 10%, like what Paul Volcker did. And then,
that's a good point. Yeah, so there's rising credit that we're already seeing.
yeah, and
Okay,
if,
so
yeah. So if we're gonna get,
and
yeah, go ahead.
the sparrow and the sparrow in the in the swallow in the cave, when there's a
Mhm,
poison, is the housing market.
mhm,
So we're seeing a high inventory, high price, high mortgage rate. So it's like that's the initial sign, they say,
mm,
of a possible recession when when the market housing market collapse,
right. And
and
if
we're
we're
seeing signs of it.
Yeah, slow down for sure. Lower application, higher interest rates, more overall we're gonna suffer some winter, or as what they say, a slowdown in the housing market. Here's the data from the St. Louis Federal Reserve, the quits rate. So less and lesser people are now quitting their jobs, not as high as back in December of 2021 when the stock market was hitting all-time highs. Now we're slowly seeing a slowdown as well on the quit rates. So that kind of shows that the power is starting to go back or shift away from the what do you call that, the great resignation, or the employees back to the ones who are providing the salaries, the businesses. So
Mhm.
regardless, so this is another chart, the financial conditions. The higher this goes, the tighter the market. What's interesting about this chart, okay, so it's updated as of Friday, August 26th. So it has been going down since the start of the rally, or people are thinking that we saw the bottom back in July. But I would be interested if it's updated anytime soon, if it has increased or the money supply has gotten tighter. But yeah, we're gonna look at now the weekly performance. So each and every sector are down. Thank you to Jerome Powell and the Federal Reserve. For the past month, we're just seeing a couple of industries that are in the green. Both are energy and utilities. The red are the rest are in the red. Um, since the start of the year, there are only two sectors that are in the green. One is energy, up 28.9%. Utilities up 3.6%, and the rest are down in the red. Worst performing sector is the communication services, followed by technology. So if your portfolio is heavy on tech, like yours truly, your
And mine
portfolio
as well.
your portfolio is down under. I'm not sure like what percentage now is my portfolio. I was happy to see it in mid 15s, losing 15% since we started the rally, but I haven't looked since the sell off since last week. So I don't know. We'll leave it there for now. Are you? What are you? How about you, Wawi? Are you trying to buy more at this point in time, or just stay put?
So cash flow is the thing. Um, so I'm waiting for my next paycheck to to buy the dip,
Hmm.
but it may be too late if it ramps up again, if there's another rally. So really it's difficult to time the market. So again, the advice is just to dollar cost average. So every time I put in a few $100s into certain equities that I have,
Right.
and just recently I bought a lot of Tesla shares when it was down a few months ago. But at this time, I'm looking at the China market. So it's a bargain right now. There's a lot of Chinese stocks that are um, at a value to buy, like Alibaba and JD.com, Tencent, BYD. So those things I'm like thinking and looking. there's some risk, because it's just now that they're opening their books to U.S. regulators. So
Mhm.
there's still that downside risk if that becomes a problem.
What's
But
mhm.
I still see China as as still a growth sector as a whole, And if you want to like diversify, you could go choose the MSCI ETF China, to kind of get into that emerging market. I still consider China as an emerging market.
Right.
There's still a potential for growth there.
Yeah, and talking about Alibaba, Alibaba and one other company called Yum China are the first in line. Two companies that are up for audit checks by U.S. regulator. So we'll see how it goes once they they open the books and.
Yeah,
Oh,
definitely something to watch,
mhm.
because that would determine, how serious China is about opening their books.
Right. We'll see if there'd be any violations or sanctions that might come up in the near future that might hurt Alibaba. Meanwhile, Alibaba is down for the past 5 days, nearly 11%, despite the good news that they're opening their books. So it's either Wall Street is pricing in a more pessimistic look regarding their outcomes, not investigation, but accounting review. Um, Meanwhile, yeah, going back to the overall stock market, here we go with Jeremy Grantham, the guy who called the bear or the perma bear, as I would say. Like he'd been calling the stock market as a bubble since last year. So we'll see if it's right. Like right as of yesterday, he was saying that we're still in a super bubble despite the recent sell-off um, involving the stock market. Let's see if we could get a quote here on this article from Bloomberg. He says here, quote unquote, you had a typical bear market rally the other day, and people were saying, oh, it's a new bull market. And then he said, that is nonsense. So I guess he has several stages according to this article. First, there's a setback like the one in the first half of this year. Then a slight rally follows. Finally, fundamentals break down and the market reaches its low point. So I don't know. Maybe we're looking at more downtrend in the near future. What do you think, Bobby?
Well, so there's basis is probably looking at some data points there. It's been ongoing for a year now. The threat is still energy. If energy goes up, then
Mhm.
that's a risk for global economy. For recovery.
Right.
Um, Another thing that's to be considered would be the current inflation that's driving um, the market um in a uncertain position, and the rising food prices for one, and the global disruption that's going on. Country going broke, um, the war
Mhm.
that's ongoing. The stabilizing factor right now is OPEC is committed to helping stabilize prices. But if their country is threatened, then we're in trouble again.
Right.
Uh,
And
so
mhm.
so we don't know the geopolitical risk. There's some tensions going around. China is still on a lockdown. They're not producing as much. So, but in the U.S., they're seeing some easing at the ports. So the ports are now moving products into the continent. So at least that's a good sign that we're uh, getting the products that the consumers are demanding. So
Mm.
that's a good sign. That's deflationary.
Yeah, and oil now is set to be at its longest losing streak since 2020. So oil has been going down since for the past 3 months now.
Yeah, but
So
the litmus test would be what you call this in the winter time.
Mm-hmm.
when Europe will be tested. If they have a bad winter, then there's another increase in risk. But Germany is saying that they already got their stockpile
Yeah,
of oil
their
2 months
capacity.
ahead.
Yeah,
That's to be tested.
yeah.
Other countries may not be ready in Europe.
Well, yeah, we'll see how far that goes because Russia just decided to do a maintenance for next 3 days, halting any supply at all through their Nord Stream pipeline. That pipeline supplies all of Europe. So we'll see if Russia is just honestly like doing any maintenance work, or maybe they're using it as a threat already because of the ongoing war between them and Ukraine, and all of the Western allies supporting Ukraine and supplying them with armory and infantry. No, not infantry. Infantry are military men, but supplying them with weaponry. So we'll see how that goes because it's not even winter, and we'll see how long that capacity supply would last. And you're right, Wami. Yes, winter is coming for sure. So might
Mhm,
not be a good idea to short oil at this point in time, but we'll see how it goes.
mhm.
Until now, it's been going down. Mhm.
So I'm keeping my Exxon investment as a hedge for that potential trend. Um, Having said that, it's going to financial planning. It's always good to create a budget, for these kind of things. Um, Try to save up, maybe carpool, you know, so you can save on gas as well. And another thing is, plan for your taxes because we're just a quarter before the year ends.
Right,
So you got to think about what you need to do about your taxes.
right. Well, on to our next slide. My next slide here is it's a graph from Bloomberg. It says, "Wake me up when September ends." So September has been worst month
Mhm.
for U.S. tech stocks over the last decade. So on average, each and every month, the stock market typically, on average, on the past 10 years, have been positive from 0 to at least 5%. July actually is the biggest comeback or biggest rise among the Nasdaq 100. But there's no in an exception. Only 1 month, September, has always been negative. So we're already down today, first day of September. So we'll see how low we could get.
Yeah, and if we're talking about experience and history, they also say that uh, two series of GDP drops um, is also an indicator of market becoming bullish after
Mhm.
two drops in the GDP.
Yeah, and then what is that one?
Right. So we haven't had this in a while, but I guess we can fit like a short interview from Morgan Stanley's Mike Wilson before we end this episode, right, Maui?
Mm-hmm.
All right, let's roll the clip.
Is how ugly does the job market get? And then what does that wind up meaning for the equity market? Chief U.S. equity strategist at Morgan Stanley, Mike Wilson, thinks investors are way too preoccupied with the Fed. And I get that idea, but there is the line between earnings and the Fed, right? I mean, if we're going to see 5% unemployment, we already see 20% jobs cuts at Snap, say Bed Bath and Beyond. What does that mean in your world?
Yeah, I mean, look, the Fed is relevant. I just think that we've priced most of the Fed pain in the first half of the year, right? All of the PE compression that we experienced was due to the Fed, getting around on inflation risk, rates going up a lot, and then multiples came down by 30%. And we break down the reason we can make that statement about the Fed is sort of priced is when we look at the PE ratio. We look at two components: the 10-year Treasury yield, which is the cost of capital, which is what the Fed sort of controls, and then you have the equity risk premium component, which is really the market's way of discounting the risk to growth. And the interesting thing to us, Alex, this whole year, the equity risk premium has not risen at all. In fact, it's well below where it was at the beginning of the year today, even though we think the earnings risk is now upon us, right? We're cutting numbers, and we think the numbers are going to come down even further in the next 2 quarters. So So the bottom line for us is PE multiple is wrong again, not because the Fed is going to be hawkish, but because the equity market is being too optimistic about the earnings outlook. And usually the way that resolves itself is the multiple will start to come down as earnings get cut. And then somewhere in the middle of that earnings cut process, the market will bottom. And we think that's probably sometime between probably September and December.
Okay, and how painful will that fall be then, Mike? Good to see you. How painful will that fall be before equity markets bottom and find their way out of this then?
Yeah, I mean, look, we've already had a lot of pain, obviously. So I think for the average stock, if I look at the market in June, we had one of the lowest breadth readings, in history. And that's why people got excited with this rally, because we had what we call a breadth thrust, meaning a lot of stocks participated in this rally. And that is technically potentially a good indicator. However, the index usually is the last thing to fall. So meaning June probably was the low for the average stock, but the index, we think, still has to take out those June lows. We've used 3,400 for kind of the quote unquote growth recession or soft landing, as you might want to call it, or a proper recession would be something closer to 3,000, where the numbers actually come down quite a bit further. So we're below the street on earnings estimates right now. We're probably going to have to take those down lower, as everybody else is too. And it's a guessing game. Nobody knows the answer, but the direction is down.
So nobody knows earnings would go down. Proper recession will be at 3,000. So that's quite a dip from where we are at right now. We're at almost 4,000. So, I mean, it's not like I don't believe this guy. This guy has been correct all this time. Even before the start of this year, he was already, preparing his investors that the stock market would go downhill because of the inflation and the price reevaluation. So I don't know, Huawei. Do you believe him? Do you think we will still go down from here? 3,200, 3,400, 3,000?
Well, we're right now, I think, my opinion, there we're just testing the 3,800 support right now after it went down below 4,000. So what I'm saying is, the large companies have already forecasted a slower growth. So we're expecting that, we already priced that in, but with the added sentiment being negative, we're probably going to see the index go down lower.
So yeah, he's saying the proper bear market would take us to 3,000. Those are the levels not seen since July of 2020. So that's when we just started rallying. So that's quite a big drop from here. So hopefully we don't reach that point. That would be devastating.
That would be, I guess you could consider that a recession, but hopefully we don't see the levels we saw in May 2020 when the pandemic was starting.
Oh, that was probably will be the worst. So I don't see any pandemic, hopefully, that can come back like what just happened and took the whole world, in a lockdown. So, yep. So my guess at this point is we're gonna be in recovery early next year. What do you think, Huawei?
Well, their chances are yes, because some experts are saying that we're in the late cycle.
Well, we'll see how it goes. I guess that'll do it for today's episode. I hope you guys have picked up something from our chat, me and Huawei. So we try to do this once a week. We've been cutting it shorter and shorter, so it'll be like more easy to follow on, at least on a once a week basis. If you have any questions, send it over to Mark Yu and Huawei Show. Again, this is Mark Yu signing out.
And Huawei Santos signing out.